Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. All right, good afternoon, everyone. Thank you for joining in on my Tuesday session on real estate and taxes. Today, we're going to be talking about what is the difference between an asset sale versus a share sale and what should you be picking. But before we get started, let's look at the agenda for today. First, we're going to be starting with the agenda where we're going to describe what is an asset sale and followed by what is a share sale. What are some of the perspective from the buyer's perspective, from the seller's perspective, and some of the pros and cons, followed by the conclusion. So let's assume you want to buy a business and you want to know what should you be doing. Should you be buying in assets or should you be buying shares? This presentation will basically answer all of those questions. But before we get into the nitty-gritties, let's define what is an asset sale and what is a share sale. An asset sale is where you buy individual assets. Just like the name describes, whenever you're buying a business, you're going to be buying their inventory, the equipment, any of the leasehold improvements. Each of these are technically assets and you'll be buying and valuing them individually to acquire this new business. Now let's look at what is a share sale. A share sale is actually a purchase of all the shares of an existing corporation. In this scenario, you're not going to be individually handpicking all of the assets that you want. You're going to be getting all of the assets that they have, whether it's brand new or whether it's old, and you're going to be getting all of the liabilities as well. Everything gets part and transferred to you seamlessly in a share sale. Now that you have fully understood what an asset sale versus what a share sale is, let's look at some of the perspective. From the buyer's perspective, asset sale is great because you get to cherry pick assets. You're going to be picking customer lists, suppliers, negotiated contracts, any of the goodwill, reputation, everything gets transferred to you. You get to also depreciate all of these assets for the rest of the life, or based on the fair market value that you purchase, you can basically depreciate the assets as well. And the best part is you get to leave the liabilities. You don't have to get all of the assets and liabilities. You can cherry pick the assets and you can leave out the liabilities. So from the buyer's perspective, this is technically valuable. From the buyer's perspective, on the second side, which is the share sale side, there is some things that you need to keep in mind. When you're buying a share sale, you don't just get the hand-picked assets, you also get the liabilities. So the due diligence is a lot more, but the good part is there's seamless, acquisition. You basically walk into the business, all of the operations, all of the negotiated contracts gets transferred to you, and you don't have to renegotiate with your landlord. So this is a great way to walk into an existing business, take over all of the business without creating too much of problems with the operations. Now that we have looked at the buyer's perspective, let's look at the seller's perspective. So if you're doing an asset sale, you're going to have to make sure that whenever you're giving out all of the list of customers and list of assets, make sure that you do your due diligence before passing it on to the seller. Because what happens is when you hand out all of the assets individually to the buyer, they're going to do more due diligence. Once they're doing more and more due diligence and they're going in depth into your business, there might be some instances where they find something that is not really something that they like and they can reject the sale. The second good part with asset sales from the seller's perspective is you get to choose which assets you want to sell. Maybe you have a business where 30 years of reputation was built with the brand and you only want to sell that location but not the brand name. So you get to handpick and choose that, hey, I don't want the deal to have the naming rights to the business transferred. I want to keep the name, and you can take over all of that locations, assets and equipment and so on and so forth. Now let's look at the share sale from the seller's perspective. If you're doing a share sale, technically you get to not pay capital gains taxes, which is primarily the reason why you would want to do it. In Canada, if you're running an active business and you get to you decide to retire, you don't have to pay taxes on $1.25 million worth of capital gains, which is amazing if I do a share sale. From a share sales perspective, buyer would also might want to do some potential post-sale indemnity clauses. So in your lawyer's agreement, you would want to put this in indemnity that anything before the share sale is belonging to the previous owner, and anything after that date will be belonging to you. Last but not the least, a share sale can also help you build and maintain reputation of the business. In a share sale, if you're transferring everything, the naming rights, the reputation, the goodwill, you get to keep that, and basically the new owner can technically run it, and it saves the reputation, which can build loyalty with the customers. Now that we have talked about the buyer's perspective and the seller's perspective, now let's look at some of the share sale pros and cons. So very first important pro would be capital gains exemption. You get to not pay any taxes on $1.25 million worth of capital gains that you might have from sale of this business, which is amazing. So the second point is land transfer tax can be skipped. If you just have the directors changed and share through a share sale agreement and the new directors take over the existing corporation, land transfer tax can potentially be skipped. Third important aspect is it is a less complex transaction if you do a share sale. It's seamless. So that is why this is the third important pro for this. Another pro would be the losses from an existing business to the new business can be transferred if you're doing a share sale. So that's another advantage to reduce your overall taxes because you're using prior year's losses against your current year income. The only con that I would want to talk about is if you're doing a share sale, both the assets and liabilities transfer. Not a lot of times you want the transfer of liabilities and issues, maybe tax compliance, legal lawsuits, to be transferred to the new business owner. So that is the only way where I would say that there's a disadvantage to do a share sale. We just talked about the sale of shares pros and cons. Now let's look at the pros and cons for sale of assets. From the sale of assets perspective, you can depreciate all of the assets, which is a good point because for the remainder of the life, whenever you get the new asset at fair market value, you get to write off against your business income, which can reduce your overall taxes. One of the cons of having an asset sale is the dual taxation. When you sell shares, you have to pay taxes to the government from the corporation. When you pay a dividend or a salary from the corporation to yourself, you have to pay a second layer of taxes. Another pro for having an asset sale is you get to choose which assets you want and the liability. So in conclusion, overall, the seller would always want to do a share sale and the buyer would always want to do an asset sale. My suggestion is work with your lawyer, work with your accountant to work out an hybrid transaction, because otherwise it's counterintuitive to put two deals together where one person is asking for asset purchase, the other side is trying to do a share sale. With the legal and the accounting help, you get to value and accurately what the fair market value of the business is, how the assets need to be priced. So you get to negotiate and work out the best price possible. And with that, I'll wrap up today's presentation. Thank you very much for joining. We'll see you next week at Tuesday at 2 p.m. Thank you.